Hi everyone, this is Paul Lang from DTS and I want to introduce you to what you're about to watch. This is an hour-long event that was presented live to free members at Disciplined Trading Strategies. It's called Top Stats for Any Trader, and I'm going to discuss the importance of trading statistics. To me, it's the only way to improve. If you're a fully trained trader, this is how you keep improving. If you're brand new, it's the only way. If you're trying to learn on your own, which is difficult, it's the only way to do it. I did do a couple of similar events at DTS, but the last one was over 4 years ago, and this one is presented a little bit differently. So it's a very important one to watch. And if you like this event, there are many other events on the DTS free stuff page that anyone can access. Recent Trade of the Week videos, as well as the most recent prior educational events like this one. So for now, sit back and enjoy. Good evening, everybody. Sound check. How's everybody doing tonight? We are underway. So welcome to tonight. This is called Top Stats for Traders. Stats, of course, means statistical analysis, a little short. That's true in any industry. And it occurred to me that I should have, you know what occurred to me? It occurred to me that I should have put a slide in here about Moneyball. Because Moneyball is a movie about baseball where they just said, hey, the stats are everything. Forget everything. Forget your instinct. Forget what you know. Forget what you think about the players. Stats are everything, right? And that's what it is in trading. You can tell me what you want, but your stats end up saying it all, right? There's no glitch of the matrix. All right. So let's get going for tonight. The only way to improve, and that's when I was sitting here thinking about it while I was waiting for 5 o'clock. I was saying the only way to improve, and it just hit me, Moneyball. It's exactly what that was about. So let's begin for tonight. Top stats, stop statistics for any traders. This is the opening slide that you get in your email. I have nothing more to say about that than what's there. Tonight is going to be kind of a little bit different thing. Time really flies by. I often think about what topic to do next for the educational event. And it's been kind of back of mind to do a statistical one because I know I've done a couple before, but it's been a while. And I kept thinking, well, it was too recent. The last one was 4 years ago. And I keep thinking, well, it was too recently. Time really flies by. So I've done this a couple of times before. Tonight's going to be a little bit different. It's going to be kind of a hybrid. I want to quickly review the key slides because, nothing changes much. But I want to go on and tell you just a little different hiccup in what I'm doing or what I want to present to you. And the reason why. It's almost 8 years at DTS. I've done similar events a couple of times, but not for about 4 years. So in the prior events, what I showed was my personal tracking sheet. And I explained back then, here's the little problem with this, is that that's a sheet I always use. It's a sheet I created for myself. I didn't buy it anywhere. It's a sheet that I love and understand, but if I gave it to somebody else, they would look at it like I'm crazy because it's not very intuitive. I created it, so I know how to use it. I know what it means. And the problem was, though, that I used that my whole career until I started at DTS and I started keeping, stats for the room because I couldn't use my sheet. It wasn't intuitive. Nobody would get it. So I made a simpler sheet for the room. And I just decided it wasn't worth double keeping the sheet. So I really don't use mine anymore since I started DTS. I have pulled it out 4 or 5 times when I've had a problem of some kind and I want to go see if I could help. But when I do that, though, I got to go backfill it in for the last 2 or 3 weeks, and that's a real pain in the neck. So that's what I did for the last couple of presentations in here. When I use that sheet, since I don't really use it, I had to go back and backfill it in, for the month because I use it for the whole month to show you what I use. And I explained that at the time. So I didn't do that this time because I want to take a little different approach to it. So what I want to do first of all is kind of go through that sheet, not really go through it, so to speak, but just show you what I showed you last time and all the ideas that you can glean from the sheet. Now, tracking of your own trades, how do you do it? Well, there's a lot of different ways. You can create your own sheet if you like doing it like I did. You could, if you're not very computer friendly, you can use a piece of paper and a pencil if you want to. You really can, especially for your long-term trades, especially if you're not a real active day trader. Like I take about 3 trades a day on average, so there wouldn't be any problem if I wanted to handwrite them out if I had to do that. If you're scalping and taking 50 trades a day, then you got a different issue. You got to get something where you can download or you got to invest in some software to do that. And the other avenue is to buy a tracking sheet. They're for sale out there. And actually on my other stuff page, I have one there, and it's not for me, and I'm not involved with it. It's from an ex-student of mine. His name is Greg Thurman, and he used all of my teaching to create a sheet, and he sells it. Now I have no part of it. You just talk to Greg, but it's on the other stuff page if you want to get that. And I haven't even looked at it in a long, long time. I think he charges between 100 and 150 bucks or something, or he did. I'm not even sure. Let me just give you the link to the other stuff page. That's the page that has the movie, the book, I think, and some other stuff. So here that is. So that's a thing for you to do too. But one way or another, tracking what you do is critically important to me. To me, that's how I credit that almost totally to my development in the beginning, which was now 25 years ago. So this will be a little different. So let's run through kind of, this is what was shown last time. And again, so this is, I didn't redo this. I didn't go to the trouble. And there's a reason I didn't. It's not just going through the trouble. It's that I have added a lot of things to the room sheet, which is essentially my sheet. I'm almost par for par exactly with the room every day. And I'll show you what I added to there, which is maybe a little condensed version, but to me kind of brings out a few key things. So I'm going to go through this, show you the list of possible things you could be tracking in the value, and then show you the last couple of weeks what it looks like in the room. Okay, does that make sense? So this is my sheet, which is from the last presentation, just showing you. And some of the things that I did in here, obviously you have your money in and out and all balances. And then I coded strategies. So I have strategies in here because then when you enter the trade, you put a code 1 through 9, and then the sheet picks up on the code and then summarizes your strategy. So at the end of the month, if you have a winning month, I could tell how much money I made from each of these strategies. I think that's a great thing. I don't know if it's super critical, but I think that's a great thing to know at the end of the month, because one of the things you may do, you may devote a little extra risk units to the strategies that are making you the most money if you can obviously define those ahead of time. I use different styles of entries, so I track the entries. The entries to me are absolutely key. There are different entries that are apart from the strategies. I track mistakes. If I look at the trade and I can't properly name it or say, wow, that violated one of the things I should know. And by the way, it's usually very easy to see your mistakes at the end of the day. Any tracking or analyzing you do as a day trader should be after 5 o'clock Eastern time. When you're calm, you're settled down. If you try to grade yourself during the trading day, you will just rubber stamp everything you do, right? Everything you do is perfect. You just did it. It's perfect. End of the day, you look back and you say, how many, give me a one if anybody's ever said this. Give me a one. Have you ever looked back and said, I don't think I did that trade. I need to call my broker because that didn't actually happen. Either some idiot knocked me out and took over, or the broker just completely had a meltdown because I didn't take that trade. You ever done it at the end of the day? Everybody probably has. I've done it. The source of the trade, where you got that from. Did it come from your own scans? If you're in a trading room, did it come from the moderator? If it's from your gap list, where did it come from? Can be very useful information to you. And a lot of this information, folks, where it's important, I'll talk about in a little bit. But as things change, maybe, or you may be coasting along fine, and you're doing blah blah blah, whatever it is, and all of a sudden your profitability slips or you go negative. And why? Why'd that happen? Well, this is where a sheet like this can be so tremendously helpful, because maybe, just for example, maybe when you were profitable, half of your money was coming from the gap list, and something changed in the market with the gaps, whatever it was, and all of a sudden your number one source of trades, gaps, went negative, and that's why you went negative. But wouldn't it be nice to know that? Most people can never tell you that. Time of day, another really key thing to me. What time of day you entered the trade, the opening 15 minutes, and you can divide the times up however you want to, but the time of day that you enter the trade can also be critical to your profitability. So this is a snapshot of the front of the sheet. You enter your trades, the symbol, entry, stop, exit, and then these are the codes then. The entry code, the strategy code, the source code, the time code. And then of course, when you put that code in there, the sheet picks up and groups them all together here. So at the end of the day, there were no trades after 11:30. All the profit was from 9:45 to 11, except for a little bit of profit the opening 15 minutes. And you don't have to read it that carefully. It's just a general concept here. Sources, hourly scans, gap carry, room or scanner. That means to me, I got a trade from a room member. For anybody in the room would probably mean they got it from me. And through everything else, here's the strategies in here. The all other was the number one, whatever that was. Because I had like 10 strategies, and on the sheet summary here, I only put the top 5, and then I put all other for 6 through 10. And then the different entries, what made the most money, it's different entry concepts in there. Time of day entry, boom, boom, boom. So, and then some comments at the end of the day. And I'll talk about comments more in just a second. So it was a typical day. Here's a little bit of a blow up so you can see a little bit better how the sheet flowed. And again, this is what I've done the last couple presentations, and the last one was 4 years ago. So I'm not doing that tonight. This is just a quick little summary. Quick look at the sheet, give you some ideas. Again, if you want to buy a sheet or if you want to make your own sheet or if you want to use paper and pencil, I don't care. But I think you need to end up having some of these numbers. And then, of course, at the end of the week, it summarizes, end of the month, it summarizes. So all of these statistics then carry through, and that's where you really get some meaning at the end of the month. One of the things I want to bring out now as we talk about stats that most of you, probably know. I'm not a statistician. I don't even really like it that much. But one of the things about stats is you have to have a significant number of stat entries before you make a decision about something, right? You don't just have 3 gaps that go bad and decide I'm never trading gaps again, right? So it's really at the end of the week, the end of the month, where you really start to analyze this. Every day you can look at it and say, okay, I get it, but don't make any big changes. And then at the end of the week, end of the month, that's when you start saying, okay, what happened here? Here, the gap list this month ended up slightly negative on the gap list. What happened that month? Hourly scans is where all the money was. Time of day, almost everything that mid-morning, which is still true for me, virtually everything I do is at mid-morning time. Shorts, 3 times the profit of longs. I'll talk about that a little bit more today. So there's your summary, and it ranks a bunch of stuff, tracks a bunch of stuff. So that to me, I think is to me, understanding it is a very well done sheet, very complete. If you were to, like at Greg's sheet, I just mentioned, Greg Thurman's sheet, it's probably more detailed and more complex. He has a whole database set up and tells you some other things. There are a lot of things that are a lot better about it. I never used anything like that because I created this on day one. By the way, yeah, TJS, right? Yeah. I created the sheet for myself, when I first started trading, just the opening weeks, months, whatever it was, because that was me. That's what I had to do. I didn't understand how anybody could trade and not understand these numbers. So think about where you are. If you're just in there hunting and pecking, taking some trades, praying for the best, not making money, I don't feel sorry for you. I worked hard at this, working hard. It's probably 4 hours a day. That's what working hard was. But you need to do these things. You cannot improve without understanding what you're currently doing, period, right? And then the summary of the mistakes, and, so you can, make sure you correct those if there are, et cetera, et cetera, et cetera, all right? Oh yeah, thank you, market rating. Yeah, again, because since I'm not really teaching this, to me, the market rating was, is it on here? Where is it? The market rating is there. The market rating, a 1 was a reversal to the upside starting an uptrend, 2 was a continuing uptrend, 3 was a sideways day, 4 was a reversal to the downside, and 4 a continuing downtrend. So it's just a very subjective view of the market. But the point of it was kind of to look at the end of the day and say, which I'm going to do for you in just a minute with what I currently do, to say, hey, the market is sideways and choppy today, or the market was downtrending today and I took more longs than shorts and I lost money, right? That's a key thing to pull out, because sometimes you get focused on a certain bias and it's the wrong bias. So you want to see that. So that was just, and again, that could be whatever you want it to be. That was not an objective thing. That was a subjective thing. Put the market in a category, up, down, reversing, sideways, whatever it was, to help give you a gauge on if you treated the market properly that day. Okay, good question. Somebody's actually reading this thing. If you're trained at DTS, the follow-up is critical before you even risking real money. The students at DTS in the second course, they'll know how big I am on this, because what really has to happen is that they need to do certain things while they're paper trading to uncover, how would you phrase this, in mastering advanced tactics, to uncover some of the numbers they need to be using, some of the tactics they need to be using. They need to have some stats going to even begin trading. And then, of course, once you get going, you're paper trading initially, you pull some stats, you start using small amounts of money. So it's absolutely part of the training process all the way around. It's imperative for so many reasons. I mean, I don't even have to explain them, I hope. If you are trying to learn on your own, there is no other way to do it. If you're decided not to get educated, just to go out and do it on your own, there is no other way to do it than to do this, because you are kind of in the situation where you're trying to learn by hunt and peck, by reverse engineering, by just kind of hoping you stumble across it. And the only way you can do that, even try to do it, is to be keeping stats that really zero you in on what to do and what not to do based on how you're trading. So this is just general. This is last presentation and this presentation. Two things I credit most of my development are trade follow-up, which is printing charts to see if you're doing what you're supposed to be doing, and then statistical analysis, which we're talking about tonight. The trade follow-up, super important, but it's not the subject for tonight. This very simply is the psychological test. It just simply answer the one simple question. Did you do what you're supposed to be doing? How many traders do this? I bet you 10%. To me, if you're not doing this, you're not even serious. If you come to me for help and I'm going to take it with a grain of salt if you're not even doing this, because the first question I always have for people who come to me with trade issues, the first question for me always is, well, this trade you took, was this your intention? Is this what you're trying to do? Is this in your plan? Did you want to short the prior high in an uptrend at 10 o'clock? Is that your plan, or was it just some fluke? And if you can't even tell me if you did what you're supposed to do, you really don't even have right talking to me, because what are we doing, right? If you're just here with a bunch of goofy trades, you don't even know what you did, what am I supposed to do with those? Just say they all stink, goodbye? What I want to see is people saying, hey, I've really worked at this, I've got these trades down, and I think these are good trades, but here's what happened, and yeah, I did what I was supposed to do. And naturally, for some of our students, I talk and help everybody, but anybody who comes to me, I think it's kind of futile to come to me if you can't even say, yes, Paul, I have an idea what to do and I'm doing what I'm supposed to do. Otherwise, it's just total randomness, right? So that's not this topic, but it's a critically important topic. I just want to make that point. That you can't even go to the next step, right? What's the point of checking? Listen to this carefully. What's the point of checking what you're doing if you're not even doing what you're supposed to be doing? Does that hit home? Yeah, does that make sense? What's the point? What's the point of doing stats on what you're doing if what you're doing is not even what you're supposed to be doing, right? What's that, hey Zen? Why do you think the number of traders is so low? Because they're lazy. Because people are lazy. Because Zen, sitting in my chair, I could sit here all day and tell you why. Because trading is easy. Because you don't need any training. Because you don't need it. Because it's easy. You buy low, you sell high. What's the point of doing that? Oh, when you have a bad day, do you feel like going and examining it? Nobody does, right? When people do review what they do, it's when they had a good day and they sit there and gloat over it. Well, you don't learn a lot from a good day typically. All the gold, all the value is in your bad days. But yet, what do most people do on a bad day? Close up shop, turn out the computer, come back tomorrow, and just hope that something changes, right? I've said this a million times in different presentations, right? Yeah, but they don't do anything about it. All right, so step 2 is what we're looking at tonight, statistical analysis, to see if what you're doing makes sense, to fine-tune and improve what you do. This is tonight's discussion. Now, here is the list of, in my mind, the total list of things that you may care about. You don't have to track all of these. Some of you won't track any of these. But the sheet I just had showed you tracks all of these, okay? And you may want to pick and choose the things that mean the most to you. And I'm going to show you what I'm currently doing, which is basically just using the room sheet from day to day as my guide. And then if I feel like I have an issue, I may go back and fill out my original sheet for a week or two to see if I can learn anything else. So batting average, everybody knows batting average, right? This is a percentage of trades that are profitable. In a vacuum, that's a meaningless number. I still can't tell you how many people come to me with just, when somebody comes to me and says, hey, Paul, I'm thinking of joining the trading room, what percentage of your trades are winners? Right there, that person is a very novice person, right? Now, I don't mind asking the stats of the room, but in a vacuum, batting average is meaningless, right? Because you could have 1 in 3 right and be making money hand over fist. And most traders I work with bat 60%, and they're losing money hand over fist. So it's in combination with your Sharpe ratio, right? Your average winner. So, having a lot of winners is meaningless if they're all baby winners compared to your big losers. So it's a combination of batting average and Sharpe ratio. Your Sharpe ratio is your average winner divided by your average loser, not your total winners, your average. Naturally, your break-even mark is 50%, right? 50% batting average and a 1 Sharpe. That means you make $500 one trade, and then you lose $500 the next trade, et cetera, et cetera. That'd be break-even. So you have to somehow get one of those numbers much better than that. And which number is better depends on your trading style, or both numbers. Some people are high reward to risk traders. That's the way I do my long term. My long term, I'm under 50%, but I'm in a 3 to 4 Sharpe ratio. Day trading, I'm a little different. Day trading, I'm a little quicker and closer to 50% and closer to 1.5 approximately, although I haven't done it very recently. Batting average winning trades divided by total trade Sharpe ratio, your average winner, which would be total winning divided by number of winning trades, divided by your averages or total losing dollars divided by losing trades. So those are some basic numbers. If you're not sure about those, you can always look those up. And by the way, while you're on that page that I just gave you, way at the bottom is the Greg's tracking sheet if you want it. And again, this Greg Thurman, and again, I have no involvement with that, so don't bother me with it. But that's on that page is also the only book that I ever recommend, even though I've written 2 books. This is the only book I recommend. It's called Trading Way to Financial Freedom. It's discussed on that page as well. You can't buy it there. You have to go buy it wherever you buy it. But it's what I consider to be, and I'm mentioning it now because it's a book about statistics and about some of the things we're talking about tonight. So what else would you like to know? How about money made long versus short? I'm going to talk about that more in a little bit. That is absolutely one of the things you want to keep an eye on, and I'll show you why in just a minute. How does it compare with the overall market trend? Money made per strategy, I showed you that on my sheet. If you are set enough and skilled enough that you actually have defined strategies that you're tracking, that's great to track those strategies. And again, a lot of the tracking is helpful to see how things change over time, right? Over time. When things are going along great, nothing's a problem. When you start to have a hiccup or two, that's when you can step in and fix it before the wheels totally come off, right? I mean, just picture anything. Picture an air conditioner, right? You hear it rattling out there. Well, just like you're trading, your air conditioner's running fine, your trading's doing fine. You get a little hiccup in your trading, you start to have some losses. Well, your air conditioner starts rattling, right? If you're trading, if you ignore your little hiccup, your losses may become bigger losses and you fall apart. If you ignore the air conditioner, that little rattle may turn out to be that your whole fan motor broke now, or your compressor broke. But if you called somebody out, or if you knew about air conditioning, you could have gone in there and fixed it easily, cheap. Now you need a whole new air conditioner. So it's the same thing. It's just kind of like giving you a little heads up, a little look as to what's going on. So keeping track of any one of these could give you a heads up that things are changing and where it's changing before you get into trouble. Money made per time of day entered. Again, a big one to me. Track the time of day you entered and what the profit was for each time of day. Money made based on the source. These were on the sheet I showed you. You don't have to do a whole lot more there. Money when market is up versus down. What pattern? In other words, your profit compared to the market pattern that day. Some people, for example, are perma bulls. They're going to be long every day, even when the market is clearly in a downtrend. If you get slaughtered at the end of the day, I sure hope you look back and say, well, okay, I had 5 long trades today. I lost money and the market fell like a rock. Why did I do that? You may have a built-in bias that's hurting you. How many trades had mistakes made? Doesn't matter if it's a winner or a loser. You could have mistakes on winning trades as well too. If you're not aware of mistakes, you will never eliminate them. Money made per time of day entered, and general comments that may have stuck out for the day. Now, some people talk about a trading journal. I don't know exactly how you define journal. I have no problem on a tracking sheet like this to add a few comments that maybe stuck out. Whatever felt relevant to you. I do not believe in a trading journal instead of mathematical tracking sheet. I think a trading journal in that sense is somewhat worthless. Some people like to use them. I don't understand it. I'm a numbers guy. I'm a math guy. At the end of the month, I'd like to know what percentage of my trades were this, what percent were that. If you have a diary with a bunch of comments in it, how do you average that? How do you synthesize that? How do you glean anything from it other than to go back and reread everything? So I don't think that's very helpful at all, but putting a comment or two in an otherwise statistical journal I think is fine. All right, so to be clear, what I've done so far, talk about things that apply to tracking across the board, period. The importance of it, why you should do it. I showed you a whole list of things just now that are all, I think, very viable things you should be tracking, could be tracking, want to be tracking, all of them, none of them. There's a total list for you to help you get going. I showed you before that the tracking sheet that I used to use and that I used in the last two presentations to make my point. What I have done this time is I've not gone and filled out my tracking sheet because I, I don't do it regularly because it's double work for me. Like I said, since I started DTS, I track the room and I've just been adding things to that. Let me show you what the room sheet does, because I think for a fairly simple sheet, it does a lot of important things. So let's take a look through that in a second here. What do these slides say? Statistical analysis, very important, is to fix problems if you're not profitable, right? So if you are having troubles, the stats that you're looking at are your number one step, your most important step to fixing the problems. That's where you get started. Now, naturally, I'm assuming that I'm talking to traders who know what they're doing. Obviously, the first step for 95% of the people I talk to is, I don't mean my seminar students, but I mean other people that come talk to me. 95% of the problem is they just don't have a clue what they're doing. They don't. So they're not going to make money. But if you know what you're doing, right, and you have a good handle on statistical analysis, and if you're having a trouble, the number one way to fix that problem is through looking at your stats, right? That's it. That's what you do. That's how you fix things. To me, this was by far and away my number one thing that helped me in the beginning. That just absolutely was it, period. I learned a lot from it. And also, number two, statistical analysis is to alert you to problems whether you're profitable or not. So if you're not profitable, you got to fix things. But if you're cruising along and maybe you're profitable, maybe you're a little unprofitable still, there are things that will help you tremendously looking at this from day to day. Which leads to number three, if it ain't broke, don't fix it. Meaning, if you're doing fine and you're profitable, don't overreact to anything on your tracking sheet. However, be aware of what the stats are saying. There's a big difference there to me, right? Don't fix things that aren't broken. You may be doing something that somebody else looking at you may say maybe a little offbeat. Maybe that's not just perfect. Maybe you made money, for example. Is there a slide for this or not? For example, maybe you made money last week with more longs than shorts, even though the market was falling. Okay. Now that doesn't mean you did wrong, right? Number one thing, make money. That's the number one thing. If you're making money consistently, you can prove it. Hats off to you, congratulations. There's no insults, there's no comments at all, period, right? But notice it, be noteful of it, right? Because if the next week, again, the market is falling and you try going long and you start losing, be aware of what you're doing. Now, there's not necessarily something wrong with being long in a falling market. Why would that be? How could you be long in a falling market and not call that a mistake? How could that be? Unique plays, stocks on their own page. Unique stocks, gaps oftentimes are on their own page. So it is very possible that you could have been, long in a free falling market or short in a bullish market, and there wasn't necessarily anything wrong with that, right? If you're a good trader, you could find those things and they could do them. I just want you to be aware. I just want you to know, hey, market fell, I was long, and I made good money, but hey, that's what I did. I just want you to be aware of it, right? There are always rebounds. Well, that's not a good answer to me, Lope. That's not the way you make money. No, you don't go against the trend. No, that's a bad answer. Sorry. It's not okay to make money long in a falling market if you're trying to get the dead cat bounces, as you're saying. That's not a good way to do it. Unless you have a specific strategy to do it, and it's very, very rare. Pierce, I have a question on that for market statistics. Go ahead, or maybe wait just 2 minutes because I'm going to just talk a little bit about it here. So here is, I'm going to kind of boil this out. This is the sheet the room gets. The room all sees the sheet every week, and it's kept there, the last 2-3 weeks are always there. So this is the full sheet, and you can't, I'm not here, you don't have to read everything. I just want to kind of show you what the room gets here. And this is last week. This is day by day. Monday was a holiday, so this is a 4-day week. And you can see there's Monday, there's 4 trades. And if there's 2 rows, it means that it was sold in halves or thirds or whatever. So like W day was half and half targets, not NNE half and half. Wednesday, there were 3 trades. Thursday, 3 trades. Friday, 2 trades. These were 2 separate trades on M-Chips, so 2 completely different trades. I mean, it was just an ad, but they were handled like 2 separate trades initially. So that's about a typical thing for me. 3 trades a day, 3.5 trades a day. That's a typical thing for me on a day. And then just your basic, entry, exit, percentage on each exit. The time it was exited, and this is for, people in the room. There's not really a stat I run on the exit. I don't really care about that. That's just there for room convenience. And that was the issue here. Then when I started doing the sheet, I want to keep it simple and basic for people who maybe missed that day to see what happened the prior day, whatever it is. Then I put a quick little acronyms for my strategy here. And this is people from the seminar program would understand this. If you're not in the seminar program, I'll tell you what everything stands for, but obviously you may not get the whole understanding because obviously seminar people have been through a lot to understand it all. But I put that there for the benefit of the seminar program people. These next two columns here, we're going to take these out in a minute. I'll show you. This is not a stat for me I care about. This is for room member convenience. I frequently get asked at the end of a week or something, well, how much money did you have to have in the account to do those trades at a $500 risk to make that much money? Well, that's just the total. So in other words, in a 4-to-1 day trading account, this day you would have needed $32,000. And this day you would have needed $15,000. And this day you would need $20,000. This day 19. So that's just adding up the equity you would need at a 4-to-1 account. So at the end of the month, I can tell somebody, hey, X amount is the most you ever needed. Because I just get asked that a lot. So that really has nothing to do with stats. I'm going to take that column out in a minute. And then over here, if you look up here, we're going to zoom in on this in just a second in a couple more slides. But this is two columns that I think are really super critical. When you boil it down, these are two columns I wouldn't want to live with. And that's what would have happened if you held the stock end of day as a day trader, and what would happen if you took all of the first target. And then I want you to look over here, market high and low of the day. Can anybody tell me real quickly where has been the top time for low of the day the last week or two? When's the market hit its low most consistently? That's quickly. Don't look at the charts. If you're day trading, you should know this instantly and type it on the screen. No, wrong. No. Low of the day has been 10 o'clock. Been 10 o'clock. Yeah, actually 10 o'clock. 2 out of 3 days for the last 10 days. I'm just guessing, but take a look. 10 o'clock's been a very, very big thing. If you go back a couple more weeks, when's the high of the day? It's been unusually happening at 1:32 o'clock. A lot of times. 1:1300, yeah. So keeping aware of that, I think, is a big thing. Again, that's not a stat that's summarized or average. That's just kind of a, hey, be aware, end of the week, look back and say, wow, 9:35 was the high of the day. In other words, the market opened at the high and crashed 3 of the 5 days last week. You see that if you look at a chart, yes. But a lot of times trading, we don't realize that, hey, you know what? Market's very bullish, and every time it falls at 10 o'clock, it's getting bought. Look at the chart and see if that makes sense today, right? So it's just an extra little stat in there to keep an eye on. So let me kind of boil this down a little bit and talk about some more stuff in here. First of all, I'm going to eliminate that so we can make this a little bigger. That's the market high and low of the day. Okay, so let's eliminate that. So that expands this out a little bit. And then this middle part here, that's just how much money you need in the account, which is not a stat that I care about. That's just there for my, DTS purposes for people who ask how much money did you need that week. So I don't have to recalculate. So let's pull that out of there. Okay. So now we can see things a little bit better. And let's talk about this here. To me, once again, you have to say that most people fail because they don't know what they're doing. I'm sorry, that's just a simple answer. But once you know what you're doing, what's the next most common reason people fail? Anybody? Unquestionably, this is like asking, what's 12 plus 12? If people who know the charts basically, they understand how to read a chart, where do they fail next? Yeah, over trading. Yeah, that's true. It's kind of a side topic, but yeah. But in management in general, just in management. Yeah, in management, right? So many people that know charts come to me and I see they had trades that could have made money, then they're not making money because they just take a little profits on little tiny things, and it's everything small profit, small loss type of thing, right? Yeah, those other things are true. I mean, tight stops to me is part of management, Jim, even though it's the initial strategy to me, I call it part of management. And not in sync with the market, that's true. And over trading absolutely is a huge one. You can see, people in the room know me. I'm doing 3 to 4 trades a day and 1,000 comments. I'm looking at a dozen other stocks that all could have been a possibility. Today, actually, I gave, never mind. I gave away the good trades and I didn't take them. So if you look over here, this to me is a huge management concept to see what you actually did compared to what would have happened had you kept everything to the end of the day, and what would happen if you would have sold everything at first target and didn't hold more for being piggier. Now, this sheet, some of the stuff on here is stuff for day trading, but you do all the same stuff for swing trading or long term. Obviously, a couple things would be a little different. Like you couldn't have an end of day target here. You'd have to put an end of the move target. You'd have to look and say, okay, how high did this go before it would have stopped based on my management policy? In other words, you want to get the maximum move you could have had in there. So this first day, Monday was a holiday. Tuesday was a break-even day. In reality, I broke even. All or nothing to the end of the day would have lost money. All targeted one would have made almost an hour. So what does that tell you? What kind of day was it that day? If all or nothing, I beat all or nothing significantly, all or nothing, and by all or nothing I mean end of day, because I usually don't have firm targets when I take trades. What does that mean if all or nothing, end of day, would have lost money, all target one would have made money, and I broke even? What does that mean about the market that day, or at least the trades I took? Yeah, exactly. It was just kind of a choppy day. Right, exactly, Tim. It was a sideways choppy day because I did good managing, good in this case, because if I would have just hung on to everything, I would have lost money, right? Yeah, I keep looking up here, down here. I would have lost 1.5 R units. So I did a great job taking profits before they got taken back from me. And would have been even better. In other words, if you look at like W day, the first target was 2 R's, the second target was 1.5. So I lost some money, lost some profit hanging on. Same thing with NNE. NNE was a big one, 1.5 and then almost 0. So this is telling me that, hey, you were being piggy even trying for a second target. If I would have taken everything at target 1, I would have had a better day. Now, that's one day. Statistically speaking, what do we do after one day? Absolutely nothing. Just put it in the back of your mind, say, okay, that's what happened today. The next day was real trading, was a 2R. All or nothing would have been 3.2. Whoa. What does that tell me about that day? End of day blew me away. Yeah, either the market or something I traded had a big move and I got out early, right? So you can see where it was. It was the PDD. I did about this. I did great because end of day would have 1.5. I had a 1.4. You can't beat that. CLF was the one. I took less than a full hour profit and went almost 2 hours. I remember the trade very well. And it was kind of a mistake. I was a little anxious. It just kind of hit the prior day's low. I got a little tight with it, went out by a couple cents. So, do you see, even just sitting here, what, if you were me, what you should be learning, just what by doing this and just looking at this. LFST, I don't even remember that stock. So what did I do? I lost a little. All or nothing was the same. So everything was the same. Didn't matter what I did on that. The next day, pretty good day, over 2 hours. iRobot, 1.3. All or nothing would have lost. Well, look at the totals. So here again, I made over 2. All target 1 would have made 3, and all or nothing would have made negative. So again, we had kind of a sideways choppy day. So I did a really pretty good job because I got iRobot 1.3, which would have eventually been a full stop out, so yay. J&J got almost an hour, and that's all there was in J&J. There was no more, and that would have been closed out at 0.3, so I did better. So I beat all or nothing this day. And what was was it Talk? Yeah, then Talk, the second target on Talk gave back money. So that's what's reflected here. All target 1 would have beat me because of Talk. All right. All or nothing means that you would hold the stock to the end of the day and not manage it. So I look back at the end of the day and say, hey, where did it close? What all or nothing really means, Jim, is that you go all for your target. Either you hit your target or you fully stop out. You don't manage in between. It's a very really revealing number. My problem is I usually don't have targets, firm targets. I just have rough targets. So I just kind of changed it to end of day for all or nothing. I still call it all or nothing, but it's really an end of the day analysis. You could, if you had a target, you could use targets. It really doesn't matter. It's the same concept. What's that? Is there a star? Art usually hits targets on $20 stocks within 2 cents. We give him a 2 cent leeway, 2 cents plus or minus. So there is a huge thing there. Just in understand. Now, there's a lot of different ways you look at your management. Obviously, printing a chart out and looking at what you did, but as a summary view, as a summary fashion, this to me is really huge because if the all or nothing is continuously beating you, you know that you're chicken. You're in a market that's moving and you're taking chicken profits. Now, not for one day, not for one trade, but this is what you want to see the trend of what's happening. That's the thing about statistics. You don't overreact on any one thing, right? Any one trade you don't overreact, but any one day you don't overreact. But if you can see kind of consistently day after day, week after week, that all or nothing is blowing you away, it means you're a really good trader and you really stink at managing. And if all target one is beating you consistently, it means you're being too picky. It means you're taking stocks that have a limited range or a choppy market, which is not necessarily bad. It just be aware that every time you're hanging on to something for more profit, you're just giving profit back. So what do? You go look at those charts, the trades you took, and decide, hey, did it make sense to do what I did? I got out early on this one, all or nothing slaughtered me. Did it make sense to get out when I did? I mean, sometimes you got to look at the chart and say, hey, I did the right thing, and stuff happens. Okay, it took off that day. I would have never guessed that. And that's what I say some days. Some days you look at the chart, like CLF is a good example. Look at the chart of CLF that day as a short. It's like, you know what? I didn't do that right. That really should have been CLF longer. I just kind of wimped out on it. So that's what you have to do then is when you have these stats, is then go back and kind of evaluate. And I know some of you are sitting there thinking, wow, this is a lot of work. Is this a lot of work? If you're day trading, I advocate that you sit in front of the computer trading not more than 2.5 hours. Right, Eric? We're there 2.5 hours typically at the most, right? And if you take, reasonable trades a day, 2, 3, 4, 5 trades a day, um, you can put this tracking down during the day. When you take a trade, you can just fill this out, or you can set up the sheet in a way that you also could download your broker sheet and match it to your sheet and just kind of pop it into there. But either way, you're talking about just, God, I don't know, 10 minutes to fill this out. If you're crippled and you have a broken thumb and you've had 6 glasses of wine, probably 10 minutes to fill this out, right? And then what are you doing to fill it out? Well, gee, I don't know, let's go back, look at the charts the next morning or later that night and just see, hey, what do we do compared to what we should have done? I mean, this is not a big process. It's a mental block for some people. And yeah, you have to come up with some kind of sheet, whatever to do. And again, I don't care if you use paper and pencil and use a calculator and average it out. Just create the simplest sheet in the world if you know Excel at all. It's not a difficult thing to do, but you need to do something to get you in the forced habit of reviewing yourself as if you're the student grading, as if you're the teacher grading the student. And of course, there's some things you can't grade. I mean, some of you can, but some of you can't grade often if that's a good or a bad trade because all you know is kind of it worked, it didn't work, you're not really sure if it's supposed to work or not. But some of this management stuff, you can. You can go back and say, boy, based on how I trade, I was not supposed to exit that stock there. And it would have made the whole week's goal if I just would have walked away from it. Instead, I got half a day's goal, right? Questions? I got a couple more things here. So that's these comes, and again, this is just the room sheet that I've just kind of adopted to use. And when I have trouble, I may fill out my one. I haven't done that in a little bit of time. Let's take a look down here then. Well, day and overnight, and here I'm not doing anything overnight, so this sheet is all day. That's just there. If I were to do something overnight, occasionally I do with the room, but generally not. So that's just day only. But let's look at long short. There's number of trades, total profit. Let's look at long versus short, and if there's not a mistake, those two add up to that, and they do. So almost evenly split that week. What does that mean? What does it mean that I had even longs and shorts? What does that mean? Is that good? Is that bad? Is that what you should shoot for? What would I use to grade that? It's a real question. Well, I'll grant you it could be a little bit of style. But it also has to be somewhat objective, right? Your stats on each side. Well, to me, I'm going to show you this next slide. To me, this is what's important. Recognize the patterns. Mark's getting warmer. Any other guesses there before I show you the next slide? Someone is typing. Did we move? Yeah. So let's take a look at the bottom line there, that bottom section. Here it is. So there it is, popped out. Long, short for the week of the 26th, about even. Boom. Isn't that part of what I want to be looking at? Now, I tend to be a little more short bias, and that's okay if you make money doing it, right? What do I want to look out for? I want to look out for a week where, long made money, short lost money, and the chart was like this, right? That's where there's a problem. Now, for this week, half long, half short, that looks perfect to me, doesn't it? Again, just because the market is up doesn't necessarily mean I'm going to take long trades. There's a market bias, but a lot of my stock trades, I will say, have nothing to do with the market today. But in general, it would be kind of hard to short this day, right? As a matter of fact, that's the sheet I have up, right? What was Monday? Oh, that was Tuesday, right? That's Tuesday because we were off Monday. Tuesday, I broke even. And what did I have? I didn't even think to look at this. What did I have? I had half long, half short. And, well, one short loss, one long lost. So probably it probably cost me to be a little too short biased that day. But isn't this a key thing, right? Bullish day, sideways day, and then a couple of very bearish days. And, this one is a pretty easy one to spot. So half long, half short seemed like the right thing to do. Decent week, right? And one more time, where a lot of people is, where a lot of you may be, is that you want to be careful if your longs made good money, but you gave back a lot, or where some of you, I'm talking to permables, where some of you have to be careful is that you had a market like this that was down, and your shorts made very little, and your longs lost, right? That's where you have to be careful, because you see something like that, you have to look back and say, okay, I lost money on longs, the market was dropping, I didn't take advantage of the short side at all. Then you got to go back and what do? Well, you look at the trades you took, and you say, hey, the market fell, yeah, but I went long a tier 1 gap. And yes, it was a tier 1 gap, and yes, I had the right to go long, it just didn't work. Oops. Okay, if that's what you feel, then that's fine. Then you have a trade that didn't work. But what if you took, like somebody said, like the dead cat bounce person, what if you took Qualcomm off the low on a bearish day and you went long? And you're looking, oh boy, did that stop out quit, right? Well, there's a huge mistake. That is what this is here to tell you, that you went long, you lost money long on a bearish market day, you took a market type stock, you went long on an unapproved setup that would never work, and you deserve to lose money. That's what you need to know. And here's the key thing, and perhaps one of the biggest points for a lot of you listening to me is, do you know, have you thought about, have you looked at any of this stuff? Or is this all like, oh yeah, gee, that's a good idea? Don't answer me, I don't want an answer. I'm just saying that's what you have to think about. All these things are just the absolute common sense basics to anybody who wants to invest long term for themselves, swing trade or day trade, right? To that, there is no argument. The week before, I didn't show you the week before. I'm just showing you the summary slide here just to make the point again, kind of long versus short, right? Now here, I made 5 times the money short, right? Profitable long, just like 1R, all the money came short. Well, what was the market that week? Take a look. Does that make sense? And again, I just lucky that it happened to me. If I made money and was against the market, I'd have to explain why. But does this make sense to you? That I should have made more money short than long on this week, right? We fell, this is the week before last, the week of the 19th. We rallied the first Monday after the gap down, and the rest of the week we fell, right? So it makes perfect sense that the shorts should have dominated the longs like crazy. As a matter of fact, it's pretty good trading that the longs are profitable. Might have been the case that longs were a little negative. So here's a big question for you. And anybody that's day trading and off on your own or doing whatever you're doing, This week, which is a great example, did you have more long trades or more short trades? And if you had more long than short, did you make money? And if you didn't make money, were those long trades you were proud of? And here's the biggest question of them all. After everything I just said, did you know what it is, Pierce? What's the next question? I just asked, did you look at this? Did you see long versus short? Did you make more money long versus short? The big question is, do you even know? Right? Do you even know the answers to these questions? And if you don't, I have to ask, are you even serious about trading? Because this is what you do. I don't know how you do anything else except do this. So you get trained. Some of you are, some of you aren't. If you are trained, this is, as I train people, this is critical to your success all the way from the day you start through continuing on. And if you are not trained or you're training yourself, this is the only way you can improve. The only way, right? And I know most people don't do this. That's my last slide. Now you have to ask 4 minutes worth of questions. Questions, comments? Did I answer your question eventually, Pierce, or do you have it sitting there ready to go? And anyone else has any questions? All right, go. I have 4 minutes and nothing to do. Jim, there will be a full, all these events, I know you're kind of new, all these events are recorded and they end up on the free stuff page. And lately I've been sending out an email telling you when it's ready. Typically it takes to the weekend before it's prepared, okay? Yeah, so you'll get to hear it again, hear it in slow motion, listen to it backwards, watch a movie while you're listening to the sound of this, whatever you want to do. Pierce, it's along the lines of what you were just about saying there. Okay, Pierce, how does the market direction statistics help in the future as far as day trading? A lot of positions are taken early, let's say before 10 a.m. or before you have clear direction of trading. How does tracking that help you adjust for future trades? For example, had an expectation the market would rise in the day due to some technical framework. So I take a position in a stock long before the market fails. I'm stopped out of my position. When I put that on the tracking sheet, I have a position ongoing against the return of the market, but don't see. Well, I think, Pierce, here's how I'm going to answer your question. Let me think of a very quick analogy. Here's the quick analogy. Did you just ask another question? My screen keeps moving. Okay. Here's a quick analogy for you. I'm a new firefighter. Okay. I'm a new firefighter. And is this going to work as an analogy? And they told me to put my hand on the door to see if it's warm. But sometimes when I open the door, it's not warm. There's no fire. But sometimes when the door's warm, I open the door and I get burnt. I mean, you can't think of the statistic, Pierce, like something that you would look back and immediately said you did wrong and right. It's the knowledge. It's knowing to say, hey, here's what you want to see, Pierce. Is I don't have in my head exactly the situation you gave. But if whatever that was that you said, and you said it didn't help you, but if it happened 4 days in a row, wouldn't that help you? In other words, you're looking at the market wrong then, or you're not looking at the right things, or it could be just a trade you can't avoid. But if whatever your example was, if 4 days in a row you go long a market stock and you get stopped out and every one of those days the market's in a downtrend, you're looking at something wrong. And you at least just want to be aware of that. Does that make sense? So it's not like a stat is going to immediately say, change what you're doing, right? It's going to say, hey, there's a pattern here that I have to tell you, you're doing something wrong. Does that make sense? Oh, I am at the bottom here. Does that make sense? Did I answer your question? I'm not 100% sure I did. I think I did. I think I answered it. Right. Yeah, and Pierce knows all that. Pierce is a very smart person, I know. But yes, I'm not sure I got your question because it seems to be kind of, sure, absolutely. But let me rephrase the question in a different way. Okay, what is the practical application of the market direction statistics being tracked? It is just, Pierce, because here's your bottom line answer, Pierce. Wouldn't it be nice to know that in a market uptrend all 5 days, right? Market's up every day for 5 days. Wouldn't it be nice to know how much you made short versus long? Wouldn't that be nice to know? Yes? It doesn't mean it's going to fix any problems. It doesn't mean you necessarily, but if you are shorting market stocks in a continuous uptrend, I want to be aware of that. And that is what that will tell you. And that's why I said step two is to go back, look at the individual trades and try and justify them, and objectively, a day later you should be objective. You should be able to say, hey, that was not unique. I shorted something just in an uptrend. I don't know why I did that, right? Could show up in mistakes tracking, sure. Yeah, that day, if you recognize that, and one of the mistakes I had on my sheet was, went against the trend, went against the primary trend, shorted an uptrend without a valid strategic concept, right? I was going to add something because you may be touching on another topic. Let me think. Let me just quickly. Thanks, Rob. Yeah, your mistake number 9. That's you ought to quit trading if that happens more than once a month, Eric. Hang on a second. I have another back of mind comment for Pierce. Probably does. You're talking about taking them early. Okay. But Pierce, even when we take things early, don't I come to the market with a market bias? Yeah, even if some days, admittedly, maybe, I'm not sure, like today, I don't know what's going on. But a lot of days we have a market bias, right? If we rally in the morning, right, short bias all the way to lunch, right? So you have that market bias. So it's not necessarily the case. I don't think what you said is necessarily true that you take a trade before you know the market bias. Yes, you don't know the truth yet. We never know the truth when we take a trade, even if you take it at noon, right? You could be in an uptrend and all of a sudden, for some reason, the market just collapses. And you could say, well, now that I took the trade, the market changed. How am I supposed to know that? Well, maybe you didn't know that, and that's why it stopped out. Maybe you should have known that. You go back and look at the chart and you say, yeah, we're in a 5-minute uptrend, but we just ran into the gap down from 2 weeks ago or whatever it was, right? And the bottom line answer is you want to know these things because if it forms any kind of pattern, you want to look into it. All right? And that too, Eric. You know something? I told the story back the last time I did this presentation a long time ago because I saw it in my notes. But you said it shows up in your time of tracking. That's absolutely right. And that's a big thing about time of tracking. If you suddenly find that you're taking trades the opening 5-10 minutes of the day and you're tracking that, and all of a sudden that stats is going to zero. And that's kind of what we've had some of that lately. The early morning trades to me have not been as reliable because things are just a little different. That's something you want to recognize. Something that I learned, Eric, amazingly, I learned this from a tracking sheet, is that you should never enter a swing trade that opening 10-15 minutes. Because something I was tracking was, the swing trades versus day trades. I was doing a lot more swing trading. And trades that I entered during the opening minutes. And I realized there's this huge correlation. Swing trade, entered first half hour, stop out. It was like 100% correlation. Like, wow, look at that. I looked at the charts and said, you know what? That's not the right way to do this. These quick little pops the first time they trigger all pull back. And you know that today because in the room we frequently talk about wait for that lunchtime pullback. So that's something I picked up from that, even way back then. And you wait for the next entry because sometimes there is no next entry. It just fails completely. So. Yeah, well, that's a different topic, Mark. Yeah, that's a different topic. But trading-wise, though, it still means you didn't have the best trade, right? If you're pushing a stop for some reason. Stat analysis, if your sample size is large enough, and also if you have input enough variables to your picture of the past, you can certainly look for correlation. Exactly, right. Yeah, that's why I was saying, Zen, that I know from a statistician's point of view, which it sounds like you are. A normal statistician would want to see a lot more sample size, right? Here's what I always say though to traders is that maybe you need 100 to get to the point where you can start saying maybe it causes causation or whatever it is. But if you just look at 20 trades, then you're going to learn a lot. I don't care what you think the sample size should be. You look at 10, 15 trades, you're going to oftentimes see a pattern. You don't need to see 100. You don't need to see 50. You just need to see sometimes 5 or 10, and you go, what am I doing? Right? You just go, what is this? And you pick up very quickly. So it's not always about like statistical analysis, like down to penny, like we're at a bank or something. It's more or less being observant of exactly what you're doing, paying close attention to it, see if it lines up with statistics that you have, and if not, why it doesn't. That's the big thing to me, is that when something goes off kilter a little bit, is just look at it and find out why, rather than just ignoring it all the time. So I think it is hugely helpful. I have the same issue when entering 8 or 9. I simply watch the action. 8 or 9, you're trading before the market opens? You're obviously in Central Time. Oh, you are. You are. You mean before the market opens? Okay, all right. To try and figure out strength card. Okay, I don't do that. The pre-market is kind of not really trading. It's kind of the Wild West to me. Babe Ruth studied his batting average based on ball location over the play, and he could figure out his strengths and weaknesses, resulting in him swinging at pitches, confirming his strengths, put him on. There you go. I didn't know that, Greg, about Babe Ruth, but interesting. Well, maybe you missed my opening comment today. I said I should have had a slide here. I thought about it literally 2 minutes before I started talking. I should have put a slide in here for Moneyball, because Moneyball is exactly what you're talking about with Babe Ruth, right? That is baseball just based on stats, period, right? Forget your gut, forget who you like, forget what you normally are supposed to do, forget what baseball tradition says, forget what every coach did in the past, follow the stats because you have tons of stats in baseball. So, I don't think it's exactly the same, but it's the same thing in trading. It's very closely related that if you can find something that you're doing wrong consistently based on the stats, based on your entry, based on the time you're entering, based on the market timing, whatever it is, all these things help improve you, right? That can't be argued with, which is kind of partly goes back to Pierce's question. All right, anything else? It's 6:08. Thanks, everyone. It is June 4th. Next week, there's a Platinum members meeting, and then following Monday, bi-weekly charting. I'm for sure going to have some kind of impromptu event, probably end of next week or the beginning of the week after that, okay? I got some other topics to do. Thanks, everyone. All right, buddy, have a good night.